Welcome to today's Explainer. We're tackling a total puzzle today, straight from the cutting edge of the quantum computing sector. We are looking at a stock that has been taking investors on an absolute roller coaster ride lately. I'm talking about IonQ. We're going to unpack the hard data, the market psychology, and the fundamental business realities behind what has to be one of the most perplexing earnings reports we've seen this quarter.
Okay, put yourself in the shoes of an investor for a second. Imagine you're following a company and they report that their revenue has nearly quadrupled year over year, almost 4x growth. Normally, you'd expect that stock to shoot straight to the moon, right? But what did IonQ's stock do? It fell. It totally tanked. And then, just as suddenly, it bounced right back up. So, what is actually going on here? How do we make sense of this whiplash?
Well, let's dive into it. To solve this mystery, here is our agenda. We're looking at 1. Earnings, the good and the ugly. 2. Market reaction and sentiment. 3. Valuation and key risks. 4. The quota competition. And 5. The bottom line.
Section 1. Earnings, good and ugly. Breaking down the numbers.
Let's start with the number that honestly should add everyone popping champagne, $11.4 million. That's IonQ's top-line revenue for the quarter, and it's a massive beat against the $10.1 million Wall Street was estimating. We aren't just talking about a slight beat here. This is accelerating growth, up roughly 4 times from last year. And when you see growth multiplying like that, it's a huge signal. It means the company is rapidly moving out of the theoretical technology phase and getting actual real-world commercial traction.
But here's where it gets a little messy. On one hand, you have the good stuff. That 4x growth gives management the confidence to stick to a massive $100 million revenue target for the full year of 2026. That's huge. But then you have the ugly. Earnings per share came in at negative 23 cents. That's a wider loss than the negative 16 cents analysts expected. Why? Because the cash burn is very, very real right now. Operating expenses are up 40% year over year. They are spending heavily, to fuel that top-line growth.
And that brings us to the real culprit behind the initial stock drop, the Q3 guidance. Wall Street consensus was expecting $11.2 million for the next quarter, but IonQ guided for a range of just $9 to $10 million. It's a clear miss. Now, management did give a very specific reason for this. They pointed to timing delays on customer contracts. You can kind of think of it like a traffic jam on the way to the cash register. They're saying it's not a lack of demand for their computers, it's just a pipeline issue. The ink on the contracts is simply taking a bit longer to dry.
Section 2. Market reaction and sentiment. Behind the whiplash.
So, why the massive sell-off initially? Well, the market is always looking forward, so investors immediately punish the stock for that Q3 guidance miss. Plus, expectations were already sky high. I mean, the stock was up 80% year-to-date before earnings even hit. It was basically priced for absolute perfection. But then why did it bounce right back? Well, a massive 20% of the stock's float is shorted, and that creates the perfect fuel for a short squeeze the second buyers step in. And step in they did. Dip buyers realized that quantum computing isn't just a one-quarter story, and massive volume spikes strongly suggest that institutional smart money was happily scooping up shares on a discount.
Section 3. Valuation and key risks. Pricing the future.
The absolutely crucial point here is valuation. Right now, IonQ trades at roughly 25 times its projected 2026 revenue of $100 million. Historically, the stock is traded at over 50 times revenue, so yeah, technically it's cheaper than it used to be. But make no mistake, this is still a highly expensive growth play. Just compare it to a legacy tech giant like IBM, which trades at around 20 times its actual earnings. With IonQ, you are paying a hefty premium for future growth, definitely not current profits.
To help model this out, let's break down the risk-reward probabilities based on analyst consensus. There's roughly a 25% chance of the bull case playing out. That's where execution is flawless, sending the stock to $35 or more. Then you have a 50% probability for the base case, representing steady, predictable growth, targeting the $22 to $26 range. And finally, a 25% chance of the bear case, where delays and cash burn drag the stock all the way down to between $15 and $18. Keeping this framework in mind is super helpful for keeping your expectations grounded.
And obviously, we have to talk about what might actually trigger that bear case. The key risks are right here. First off, advancing competition from massive players like Google and IBM, as well as other pure-play rivals. Second, the macro environment. Interest rate cuts might help, sure, but broader recession fears tend to crush highly speculative names like IonQ first. And third, dilution. Yes, they have $400 million in cash on hand, which is a great safety net. But remember those operating expenses jumping 40%? If that burn continues, they might eventually need to issue more stock to raise funds, which dilutes the shares you currently hold.
Section 4. The quantum competition, the race for dominance.
Let's look at the current battlefield among pure-play quantum stocks, because they aren't operating in a vacuum. You have IonQ using trapped ion technology, and their key advantage is being the recognized accuracy leader. But then you have Rigetti. They utilize superconducting tech with a heavy focus on raw speed, and they are catching up fast on performance metrics. And finally, there's D-Wave, using quantum annealing. Their main edge is that they are already generating distinct commercial revenue. So IonQ might be a pure-play leader right now, but this quantum race, it is absolutely far from over.
Section 5. The bottom line. What this means for you.
All right, based on your time horizon, here is the playbook. Step 1. In the short term, expect volatility. That guidance miss is going to weigh on the stock, but dip buyers are clearly active. Step 2. In the medium term, the upcoming Q4 results are the real test. We need to see if those delayed customer contracts actually finally close. Step 3. For the long term, if IonQ successfully hits that $100 million target in 2026, today's price is an absolute steal. But if they don't, it's currently overpriced.
Which perfectly brings us to our final verdict. To quote the source analysis directly, high risk, massive upside, and a story that's just getting started. That really is the duality of investing in quantum computing. You're buying into a technology that could fundamentally change human computation, but you are doing it while navigating some very real, very bumpy financial growing pains.
So I want to leave you with this final thought. Based on everything we've unpacked today, the huge revenue beat, the cash burn, those 2026 targets, and the fierce competition breathing down their neck, what is your strategy? Are you a trader playing these wild short-term swings, or are you an investor who's dollar-cost averaging and holding out for that $100 million target in 2026? It's a fascinating puzzle for sure. I hope this explainer helped give you the pieces you need to solve it for your own portfolio. Thanks so much for joining me, and keep learning.